I think the dollar is going to drop another 15%, 20%. So much more to come on the dollar.
There's a lot of concerns that it could be a weaker dollar policy, something that structures an orderly decline of the dollar.
The dollar's decline long overdue. The euro and the yen are still almost 50% undervalued. The rubber band is snapping back.
Something has just broken on the US dollar. The US dollar index has witnessed its largest drop since COVID-19 and has completely disconnected from its underlying fundamentals, and this is something that could have massive implications for the economy and financial markets. Since the dawn of civilization, every currency that has come into existence has ended up dying out and disappearing into irrelevance. The people holding these currencies as they were dying out ended up seeing all of their wealth completely disappear. In the 1940s, for example, the British pound could be exchanged for $5. It was the dominant global currency at the time. By the 1980s, the British pound was only worth $1, completely destroying the purchasing power of anybody holding the British pound and having massive repercussions on the global hierarchy, global trade, and geopolitics. Today, it's not the pound that's under attack, it's the US dollar that is the dominant global currency today. And many are projecting a similar fate to the one of the British pound, possibly catalyzed by Donald Trump's new government policies. Indeed, the US dollar index, also known as the Dixie, which measures the US dollar's exchange rate against a basket of other major currencies, has been under significant selling pressure ever since Liberation Day on April 2nd, where Donald Trump announced his new tariff policies. Now, it's not been an outright collapse, but something has happened that is suggesting this decline in the US dollar could be a lot more dangerous than it looks. And that is that the index has disconnected from US government bond yields. This line basically shows us the return on investment that you get for owning US dollars. And this is the US dollar strength against other major currencies. Throughout the last few years, both of these have been very interconnected. And that makes sense. As the return on investment of the US dollar increases, the foreign exchange value of the US dollar should increase as well. This gap right here is telling us that the US dollar has been weakening despite the return on investment staying elevated. This could be signaling that something in the currency is currently breaking. It could mean that interest rates need to rise a lot more in order to stabilize the US dollar, or that if interest rates don't rise, that the US dollar could see a complete collapse. But before we can say this for sure, we need to understand exactly why this gap has been created. Firstly, tariffs are a form of tax, and from everything that we know about tariffs and taxes, we know that they slow down the economy. Foreign exchange rates are heavily influenced by local economic growth, and so if investors believe that tariffs will slow down growth in the US, it makes sense that the dollar will be weaker. Now, this could end up being quite a temporary concern because the US economy is generally in a strong shape and remains the undisputed leader in pretty much all key industries of the future, which will drive economic growth. The second reason, however, is more concerning. Donald Trump's tariff policies will reduce global trade volume. Most global trade is conducted in US dollar terms, and so naturally tariffs reduce demand for US dollars. If we're heading into a world where global trade is declining, that could put the US dollar on a sustained path to continue weakening. But the final reason for this gap could be the nail in the coffin for the US dollar, and that is that the current administration is potentially deliberately seeking to weaken the US dollar as part of its broader economic strategy. Indeed, Donald Trump has talked about wanting to have a weaker dollar many times before. After all, he wants to make American industry great again. And a weak US dollar makes American-produced goods more competitive. That can boost US exports to the rest of the world and so stimulate the manufacturing sector in the United States. It could be that his policies will be specifically targeted towards keeping the US dollar weak. And that would be very similar to what happened with the British pound in the 1940s. All of these currency devaluations of the British pound relative to the dollar that we talked about earlier were driven by two root causes. First of all, the British economy had a high trade deficit, meaning that the UK was not manufacturing locally, and that made the economy struggle. These devaluations of the British pound made British goods more competitive and stimulated the local economy. The second reason for these devaluations was the massive debt burden that the UK was facing after World War II. By devaluing the British pound, it became much easier to pay back the old debt that had been accumulated when the pound was a lot stronger. The UK government essentially chose to sacrifice the status of the British pound in order to resolve its domestic issues of high levels of government debt and high trade deficits. It's not completely crazy to compare the UK in the 1940s to the US today. The US has been increasing the size of its trade deficit significantly over the last 30 years, meaning that less goods have been being produced locally, which has completely hollowed out an entire part of the economy, as we can see from this chart showing employment in the US manufacturing sector. At the same time, the US government has an absolutely massive debt burden, being one of the most indebted countries in the world, with the size of the government debt surpassing the total size of the US economy in the aftermath of the Great Financial Crisis and the pandemic, leading to an even more severe accumulation of debt. This means the US government is in a position where it really should be cutting its spending and raising taxes in order to get its budget under control. And both of these measures can be very painful. The alternative, less painful option is to devalue the currency, stimulating the local economy and making the debt easier to repay. Now, if you are holding US dollars and you're worried about the dollar weakening, there's a couple of things that you can do. And by the way, this is not financial advice. This is for educational purposes only. The first thing you can do is diversify your currency risk. Somebody that has a lot of cash on the sidelines doesn't necessarily need to keep it all denominated in US dollars. You can spread your risk out on multiple different currencies. One of the currencies that we like is the Swiss franc, for example. Now, the return on investment on the Swiss franc is very low, but the currency has an extremely strong track record of outperformance against the US dollar. The country is in a strong financial shape with one of the smallest debt burdens in Europe, and that generally is good news for holders of the currency. The second thing you can do is buy assets. A devaluation of the US dollar would mean the price of housing, stocks, gold, Bitcoin, oil would all have major tailwinds pushing them higher. You can check out a very recent video that we published on Bitcoin and government debt that covers exactly how we should be thinking about crypto and more specifically Bitcoin in the current macroeconomic environment. You can follow all of our trades at Bravos Research. You can check out our homepage if you want to see all of the closed trades that we've had throughout 2024. We managed to lock in incredible returns throughout 2024 with our trades, yielding approximately a 60% annual return. That's twice that of the S&P 500. We think the rest of 2025 is going to have massive opportunities for investors. If you want to catch them with us, make sure you're subscribed to our service.